Hello students, welcome back to the video lecture series of corporate valuation. The problem which we are solving today is a case study which is asked for 20 marks in June-July 2018 and December 16 question paper. You can refer the slide for the question. The profit and loss account and balance sheet of Zenith Corporation for 2 years are given below. Net sales, profit and loss account, net sales is for the 2 years they have given. Income from marketable securities, we call it as interest income. Then non-operating income, total income, cost of goods sold, selling and administration expenses, depreciation, interest expenses, total cost and expenses, PBT, profit before tax, tax provision, profit after tax, dividend, retained earnings. And along with that balance sheet given, that is equity capital, reserves and surplus and debt for 2 years, and fixed assets, investments and net current assets for 2 years. Assume a tax rate of 40%. What they asked you to find out is, what is the EBIT for the year 2? Second question, what is the tax on EBIT for the year 2? Third is, what is the NOPLAT, that is net operating profit less after tax? Next, what is the free cash flow to the firm, that is free cash flow for the year 2? And fifth one, give the breakup of the financing flow for the year. So, solution for this problem. So, first question, EBIT for Zenith Corporation for the year 2 is calculated below. Is calculated as profit before tax, that is PBT, that is 1428. Okay, PBT for only for the second year we need to calculate EBIT, then plus to this add interest expenses, interest expense we should add, that is 392 is the interest expenses given in the problem, 392. Next, interest income that is income from marketable securities which we need to take minus 210 interest income. Next, less non-operating income, less non-operating income. So, non-operating income given in the problem minus 140. So, what we need to do is, first you need to add and deduct these two. The answer is EBIT is 1470. This is EBIT for Zenith Corporation for the year 2. Only for the year 2 we need to find out. Next is second one, what is the tax on? So, second one, tax on EBIT, tax on EBIT for the year 2. For the year 2 is tax provision from the income statement. What is the tax provision given in the problem? 448 in the second year. Tax provision from income statement. Income statement means P&L account. For the second year is 448 plus add tax shield on interest expenses. Tax shield on interest expense means, see, interest expense is 392, tax percentage of rate of tax is 40%. You need to multiply 40% in order to get the tax shield. So answer is plus 156.8. So this is the tax shield on interest expenses. Less deduct tax on interest income. Interest income tax you need to deduct. So interest income is 210, that is income from marketable securities, multiply by 40%. 40 by 100 is minus 84 you will be getting. Next, minus tax on non-operating income, that is 140 into 40% gives you 56. So you need to add these two, you need to deduct. Then you will be getting the answer as 464.8. Once again I will explain. See, tax on EBIT which we have found out, tax provision given in the problem 448 in the second year, okay. Then tax on interest expenses for the EBIT which we have taken interest expenses now, on interest expenses now, on the tax we need to find out, that is 40% is the tax rate. So 392 into 40% gives you 156.8. Tax on interest income, on the interest income 210, tax is 40% minus 84, and tax on non-operating income, that is 140 into 40% gives you minus 56. Then you will be getting the answer as 464.8 as tax on EBIT. Okay, third question is NOPLAT, net operating profit after tax, less after tax, that is given as NOPLAT for year 2 is EBIT is equal to 1470 which we have calculated, okay, 1470, okay, then less tax on EBIT which we have calculated in the second problem. So 464.8. So deduct that amount. So you will be getting as 1005.2 as NOPLAT. See, after finding NOPLAT, next is that is free cash flow of the, that is FCFF, free cash flow to the firm. They asked you to find out. Fourth one, free cash flow to the firm for year 2 is NOPLAT which we have calculated now, that is 1005.2, to this less net investment. Net investment is nothing but fixed cost of the current year, that is second year, minus fixed cost of the minus net current asset. See, once again I will explain. Net investment is nothing but fixed cost of the second year plus net current asset of the second year minus fixed asset of the previous year minus net current asset of the previous year. So, net investment means fixed asset plus net current asset of year 2, this is also year 2, minus fixed assets of year 1, fixed assets of year 1 minus net current assets of year 1. So, this is for year 2. Fixed assets of year 2 is 4,550 plus net current assets of year 2, fixed assets of year 2 is 4,550, net current assets of year 2 is 1,190 minus fixed assets of first year is 4,200 minus net current assets of first year is 840. Okay, first you need to add this and deduct these two. You will be getting the answer as minus 700.0. Okay, that is net investment, fixed asset of second year and net current assets of second year, fixed assets of first year minus net current assets of first year. So, 4,550 plus 1,190 minus 4,200 minus 840. Next, after finding this, next is plus net operating cash flow. Net operating cash flow is, that is net operating cash flow is net operating income. How we calculate? Net operating income minus tax on net operating income. So, net operating income according to the problem is 140 minus tax on net operating income is 56. So, what is the answer? 84 we need to add. 84 is plus. Okay. See, for NOPLAT, to find out the free cash flow to the firm, net operating profit less operating tax, which we have found out, to that we need to deduct the net investment, that is fixed asset of the second year plus net current assets of the second year minus fixed assets of the first year minus net current assets of the first year. Then add net operating cash flow, that is net operating income minus tax on net operating income gives you 84, you need to add that. Then total answer is FCFF is 389.2. 389.2. Okay, next, last one, the breakup of the financing flow is as follows. So, fifth one, the breakup of the financing flow is as follows. After tax interest expenses, after tax interest expense, that is interest expense is 392 is the interest expense. So, minus tax on interest expense is 156.8. So, 392 minus 156.8. So, this becomes 235.2. Next, plus cash dividend. That is cash dividend is 560 of the second year. We are finding out second year 560. Okay. second year dividend. Next, minus net borrowing. Net borrowing is nothing but debt of the second year minus previous year debt. So, second year debt minus previous year debt. So, second year debt is 2940 minus 2520. So, answer is minus 420. We need to deduct this amount. Next is plus change in excess marketable securities. Change in excess marketable securities means that is investments. So, the current year, that is second year investment is 1400, that is called as second year investment minus previous year investment. So, second year investment is 1400 minus 1260 gives you plus 140. This we need to add. Last one, after tax income on excess marketable securities. So, how you need to calculate this? As 210 is the marketable securities, tax, that means after tax means 40%, gives you 84. So, what you need to do is 210 minus 84 gives you the answer as minus 126. So, total breakup for the second year is 389.2. 389.2 is the breakup. So, once again I will explain. The breakup of the financing flow is as follows. After tax interest expenses is 392 is after tax, minus interest is 156.8, gives you 235.2. Cash dividend for the second year we need to add. This is plus. Okay, we need to add. Then net borrowings, that is second year debt minus previous year debt, gives you minus 420. Then change in the excess marketable securities, that is second year investment minus previous year investment, that is 1400 minus 1260 gives you plus 140. Last one, deduct after tax income on excess marketable securities, that is 210 into 40%, 84 you are getting, and then again you need to deduct from 210. Final answer is minus 126. Total breakup for the financing flow is 389.2. So, these are the 5 steps which they asked you to find out in the case study for 20 marks. Okay, and this is about the corporate valuation subject.